Hi everyone, this is Joe Gentili. I'm an attorney with Sarraf Gentile LLP. I'm going to be doing a series of videos related to some popular financial products that are in the insurance space. And we're going to be talking about some of the pitfalls with these products, some of which aren't very well known or certainly aren't emphasized by the companies making them or the people selling them by and large. The first product that we're going to be looking at today is a very popular one, maybe the most popular one on the market today, and that's a fixed indexed annuity, which is an FIA. What a fixed indexed annuity is it's a insurance-based product that you invest a sum of money into it, and every year the product is supposed to give you a return, and it guarantees that you'll never take a loss on the product. It'll never have a negative year. It's a indexed annuity because your return isn't a set guaranteed amount, but it's an amount that's hinged on the performance of some index. So when these indexes started, they were hinged most commonly to the S&P 500. So if the S&P 500 had a down year, let's say it went down 10% for a year, that's where the insurance element kicks in, and you're not going to take a 10% loss on your annuity. It'll just credit at a zero. But if the S&P 500 had an up year, then you're going to get credited on your annuity how much the S&P 500 went up. But the way the insurance company is able to give you those floors is they put caps and what are known as participation rates on it. So you may get what the S&P 500 went up on a point-to-point basis, but only up to maybe 10% or some capped amount, or maybe you'll get no cap for what the S&P 500 went up, but you'll get a percentage less than 100% of that amount. So if it went up 10% and you have a 7.5% a 75% participation rate, you'll get 7.5%. There's nothing inherently wrong with these products. They certainly have a place in the financial planning for a lot of people. Now, where we've run into problems with these is the field has evolved that you still have indexes, like real indexes that are used, that your money could be credited against. But now most of the indexes that are offered are what are called engineered indexes or hybrid indexes. And there's some very popular ones out there with some large insurance carriers. And these are not indexes that exist in the real world. They're only indexes that exist with regards to the particular insurance product. And a lot of times that the insurance carrier or maybe the salesperson will sell you these with the pitch that it's a better version of some other index. It's a better version of the S&P 500 where it'll be less volatile, and because it's less volatile, we can give you higher cap rates. They'll talk about some sort of benefit for using these hybrid indexes, but the biggest benefit that these hybrid indexes seem to have is that they illustrate really well. So what does that mean? It means that when the salesperson puts in front of you an illustration showing how the product works and what performance could look like in the future, a lot of these hybrid indexes are created for the express purpose of just looking good, looking backwards. So looking backwards from today, we had a low interest rate environment, we had good stock market performance. So you can create an index if you are looking backwards in hindsight that would show 25% returns looking back, although it has very little chance of getting that looking forward. But those indexes are still created because you're more likely to buy it if you're shown something that has this great performance looking backwards. So a lot of these hybrid indexes are created for that purpose. So be very careful when you're evaluating these. If you're being shown a hybrid index or an engineered index, whatever you want to call it, that's showing just phenomenal returns, 15%, 25%, sometimes even over 30%, you should have a red flag with that. That is not likely to repeat going forward. The other thing that's out there that's not really well understood by the public is these annuities are sometimes sold as having no fees or having very little fees. But that's not true in a lot of cases. A lot of these hybrid indexes, particularly those that are known as excess return indexes, they have a lot of fees built into them that lower your return. I've looked at some excess return indexes where there's, as far as I can tell, I don't think it's really disclosed directly to clients, but if you look at the investment bank that creates the index and fine prints, somewhere towards the back of the description, they'll have one line that's describing the fees in it. And I saw one that has all excess return funds deduct what the current interest rate is. So if current interest rates today, the risk-free interest rate is 5.3%, well, then the index return is going to subtract that off the top. In addition, they could have a rebalancing fee, a daily rebalancing fee of 0.02%, which may not sound like a lot, but if that's applied every trading day of the year, that's more than 5% in fees there. So we're over 10% now in fees on this index. And there could be another set of fees that are related to paying the investment bank, really what I would kind of call junk fees. But I've seen cases where the fees in the product are 11% plus a lot more than 11%. So what does that mean? It means that if you invested in an annuity and your return, your crediting rate is hinged to this particular index, in order for you to get a positive return, to make the first penny on it, the index has to return over 11%. That's the hurdle rate you have to jump over. That is a gargantuan hurdle rate to jump over. And I think if most people knew that, they probably wouldn't buy it. So if you're shopping for a fixed index annuity, and particularly if you're looking at something that's illustrates really high, and it's an excess return index, you really need to get your arms around the fees associated with this before buying it. And I wouldn't just trust the word of the person that's selling it to you to understand what the scope of the fees are, because I would say that more than 9 out of 10 times the person selling it doesn't understand that either. If you've already bought one of these and you're not happy with the performance of it, if the index that you thought you're kind of hinged to, the S&P 500, is way up, but you're being credited some very small amount and you can't figure out why, I'm an attorney. I'd be happy to look it over. I think that there are going to be some instances where you're going to see some class action litigation in this space because some of the sales practices, in my opinion, are misleading. I think the illustrations, if you're putting out illustrations that are extremely unlikely to be matched, I think that's a misleading sales practice. If you have all of these fees, maybe even 11% of fees in the index, and you're not disclosing that, I think that's a misleading practice. So if you've already bought one of these, you're not getting the results that you want. We're happy to take a look at the index and evaluate whether you have a legal case with that or not. So that's what we have to say today about FIAs, or fixed index annuities. Theoretically, they can be great products. They could have excellent use for a lot of people's financial planning, but with this rise of engineered indexes and hybrid indexes, there's a lot of problems in this space that you have to be careful about too. So if you have any questions, feel free to reach out. I'm happy to answer any questions. Thanks. I hope you have a great day. Bye.